In October 2022, Blackstone announced it was raising the largest real estate fund in history, $7 billion from pension funds, sovereign wealth funds, and family offices. The pitch was simple: real estate always recovers. 6 months later, they suspended withdrawals. Investors couldn't access their money. The fund had lost 15% of its value, and Blackstone didn't have the cash to pay everyone back. But here's what nobody talked about. While Blackstone was telling investors that real estate was the safest bet, the families behind Blackstone were doing something completely different with their own money. They were buying gold, not gold stocks, not gold ETFs, physical metal, bars stored in vaults in Switzerland, Singapore, and London. This wasn't unique to Blackstone. Across 2022 and 2023, the world's wealthiest families moved over $800 billion into physical gold. Not as a hedge, not as diversification, as a primary position. The Rothschilds, who built their empire financing governments, converted a third of their liquid assets to gold. The Waltons, who own Walmart, tripled their gold holdings. Sovereign wealth funds in the Middle East that had been buying Manhattan skyscrapers started filling Boeing 747s with gold bars and flying them home. This is the same behavior that happened before the 1929 crash, before the 1971 collapse of Bretton Woods, and before the 2008 financial crisis. Every time the wealthiest families see something the public doesn't, and every time they move their money into gold months before the market breaks. That pattern is repeating right now. The question is why? Gold hit $2,100 per ounce in December 2023, then $2,200 in February 2024. By August 2024, it crossed $2,500. That's a 40% increase in 8 months. But the price is just the surface. The real story is who's buying and how much they're buying. Central banks purchased 1,136 metric tons of gold in 2022. That's the highest level of buying since 1967, the year before the gold standard started collapsing. In 2023, they bought another 1,037 tons. 2 years, 2,273 tons, worth roughly $140 billion at current prices. China's central bank added 225 tons in 2023 alone. Turkey bought 148 tons. India bought 56 tons. These aren't small nations hedging currency risk. These are major economies preparing for something. But central bank buying is public. The private buying is far larger and almost completely invisible. Family offices, which manage the wealth of billionaires, don't file public disclosures for physical gold. They don't have to report it. A family office can buy 10 tons of gold, store it in a private vault, and nobody outside that family ever knows. The evidence comes from the supply side. Gold refineries in Switzerland, which process 70% of the world's gold, reported record throughput in 2023. They were melting down old jewelry, coins, and ETF bars, and recasting them into the large 400-ounce bars preferred by institutional buyers. One Swiss refinery manager said they were running 3 shifts, 24 hours a day, and still had a 6-month backlog. That gold wasn't going to jewelry stores. It was going to vaults. Brinks, the armored transport company, reported a 200% increase in gold shipments between 2021 and 2023. Their specialized Boeing 747 freighters, which carry gold because it's too heavy for normal cargo planes, were booked solid. Flight records show these planes making repeated trips from London and Zurich to Singapore, Dubai, and Hong Kong. When you track the destinations, they align with major family office hubs and sovereign wealth fund headquarters. The World Gold Council, which tracks gold demand, recorded $400 billion in net inflows to physical gold in 2023. That's not gold mining stocks or futures contracts. That's people taking delivery of actual metal, and the buying accelerated in 2024. First quarter data showed $115 billion in purchases, which projects to over $460 billion for the year. Combined with 2022 and 2023, that's $800 billion moving into gold in under 3 years. This is generational wealth moving, the kind of money that doesn't chase returns. It's preservation capital, and it's moving faster than it has since the 1970s. When families with 200-year track records move $800 billion into gold, they're not reacting to headlines. They're reacting to data most people never see. The first signal is currency instability, but not the kind reported on television. The dollar's share of global foreign exchange reserves dropped from 71% in 1999 to 58% in 2024. That's a 13-point decline over 25 years. But most of that decline happened after 2020. Between 2020 and 2024, the dollar lost 5 percentage points. That's faster than any 4-year period since Bretton Woods ended. Central banks are selling dollars and buying gold because they see the same structural problems that caused the pound to collapse in the 1940s and 1950s. The mechanism is debt. U.S. national debt crossed $36 trillion in 2024. Interest payments on that debt hit $1.2 trillion annually, which is now larger than the defense budget. The government is borrowing money just to pay interest on previous borrowing. That's the same pattern Britain faced in 1945 when its debt reached 270% of GDP. Britain tried to maintain the pound as the reserve currency. It failed. The currency was devalued twice, and the empire dissolved within 20 years. The difference is scale. When the pound collapsed, it affected the British Empire and Commonwealth nations. When the dollar loses reserve status, it affects every country, every central bank, every pension fund, and every trade agreement. The families moving into gold understand this. They're not worried about a recession. They're positioning for a currency reset. The second signal is inflation, but not the inflation measured by government statistics. Official inflation peaked at 9% in 2022 and fell back to 3% by 2024. But that's the Consumer Price Index, which excludes asset prices. Real estate, stocks, bonds, those aren't in CPI. And those are the assets where actual inflation shows up first. Since 2020, the Federal Reserve created $5 trillion in new money through quantitative easing and emergency lending programs. That money went into financial assets. The S&P 500 went from 2,300 in March 2020 to 5,100 by 2024. That's a 120% increase in 4 years. Real estate prices rose 45% in the same period. The money supply increased, asset prices increased, but wages only rose 15%. That gap is inflation. It's just not visible in the statistics that most people watch. The wealthy families see this because they own the assets that inflated. They watched their portfolios double, while understanding that the doubling wasn't from economic growth, it was from money creation. And they know what happens next. When everyone realizes that asset prices are inflated by printed money, confidence breaks. The rush to sell assets and buy hard goods or hard currencies causes the inflation that shows up in CPI. By then, it's too late to protect yourself. The families buying gold now are protecting themselves before that rush begins. The third signal is geopolitical fracture. The BRICS nations, Brazil, Russia, India, China, and South Africa, have expanded to include Saudi Arabia, UAE, Egypt, Ethiopia, and Iran. Together, they represent 45% of global population and 35% of global GDP, and they're building payment systems that bypass the dollar. China and Russia settled $200 billion in trade using yuan and rubles in 2023. Saudi Arabia, which has priced oil in dollars since 1974, signed agreements to accept yuan for oil sales. India is buying Russian oil and paying in rupees. These aren't symbolic gestures. These are the largest energy and commodity trades in the world, moving out of dollars. The families buying gold know that reserve currency status isn't permanent. It's a network effect. As long as everyone uses dollars, everyone needs dollars. But once a critical mass shifts to alternatives, the need for dollars declines rapidly. And when that happens, the trillions of dollars held in reserves around the world will flood back into the U.S., chasing goods and assets, driving inflation to levels not seen since the 1970s. Gold protects against that because its value doesn't depend on any government or currency system. This has happened before. 3 times in the last century, the wealthiest families moved heavily into gold just before a major currency or financial crisis. The pattern is consistent. The outcome is predictable. In 1927, the French Rothschild family started converting francs to gold. France was on the gold standard, but the family saw structural problems in the government's finances. They moved an estimated 30% of their liquid wealth into physical gold over 18 months. 2 years later, in 1929, the global financial system collapsed. The dollar was devalued in 1933. Gold was revalued from $20.67 per ounce to $35 per ounce overnight, Anyone holding gold saw holding. Their wealth increased 69% in a single day. The Rothschilds and the families who followed their lead preserved their fortunes, while stock investors lost 89% of their wealth between 1929 and 1932. In 1968, European banks started demanding gold from the U.S. in exchange for dollars. The U.S. had promised that dollars were as good as gold, redeemable at $35 per ounce. But European banks saw that the U.S. was printing more dollars than it had gold to back them. The London Gold Pool, a consortium of central banks that tried to keep gold at $35, was collapsing. Private families and institutions in Europe began buying gold aggressively. By 1970, wealthy families in Switzerland, Germany, and France had moved an estimated $20 billion into gold. In August 1971, President Nixon closed the gold window. Dollars could no longer be exchanged for gold. The fixed exchange rate was gone. Gold prices floated. Over the next 9 years, gold went from $35 to $850 per ounce. That's a 2,300% return. The families who bought in 1968 through 1970 multiplied their wealth 20-fold, while everyone holding dollars, bonds, or cash saw their purchasing power collapse under double-digit inflation. The third example is 2007. Family offices started selling real estate and equities in early 2007 and moving into gold. Public data from gold refineries shows a surge in demand for large bars starting in January 2007, 8 months before the first subprime mortgage funds collapsed. By September 2007, gold had risen from $600 to $740. It wasn't a massive move yet, but the volume of physical gold being purchased was extraordinary. Someone knew. When Lehman Brothers collapsed in September 2008, gold briefly dropped to $700 as investors sold everything to raise cash. But by December 2008, it was back to $870. By 2011, it hit $900. The families who bought in 2007 at $600 saw a 216% return, while the S&P 500 took 5 years just to recover its 2007 level. More important, they preserved their capital during the crash. Stocks fell 57% from October 2007 to March 2009. Gold fell 18% and recovered in 3 months. The pattern is always the same. Families see structural instability before it's reported. They move into gold while prices are still stable. The crisis hits 6 to 18 months later. Gold spikes as confidence in paper assets collapses. The families who moved early preserve or multiply their wealth. Right now, the same families are moving into gold. The Rothschilds, who were early in 1927 and 1968, started increasing gold holdings in 2021. The Waltons added $2 billion in gold to their family office portfolio in 2022. The Saudi royal family moved an estimated $40 billion into gold between 2022 and 2024. Sovereign wealth funds in Singapore and Norway, which are among the most conservative in the world, increased gold allocations by 400% and 300% respectively in the same period. These families don't trade, they position. And they're positioning now, which means they see the same pattern, forming that preceded 1929, 1971, and 2008. The difference is scale. In 1929, global financial markets were a fraction of today's size. In 1971, derivatives didn't exist. In 2008, global debt was $80 trillion. Today, it's $315 trillion. When this pattern completes, the impact will be proportionally larger. Gold purchases in the first quarter of 2024 exceeded all of 2021. That's not a gradual shift. That's acceleration. And the data shows it's speeding up. Shanghai Gold Exchange, which handles all physical gold trading in China, reported 500 tons of withdrawals in January 2024 alone. Withdrawals means someone took delivery of physical gold and removed it from the exchange. In all of 2020, the exchange saw 1,800 tons of withdrawals. At the current pace, 2024 will see over 6,000 tons withdrawn. That's triple the 2020 level in 4 years. In India, gold imports hit 100 tons in March 2024, the highest monthly figure in 5 years. India is the world's second largest gold consumer, but most of that demand is jewelry. The 2024 surge is different. Import data shows that 60% of the gold coming into India is in the form of large bars, not jewelry-grade material. That suggests institutional buying, not consumer demand. The United Arab Emirates imported 300 tons of gold in the first quarter of 2024. The UAE doesn't mine gold. It doesn't use significant gold in manufacturing. That gold is being stored or re-exported. Flight manifests show private charter flights leaving Dubai for Riyadh, Doha, and Kuwait City carrying gold. The Gulf states are accumulating. Switzerland reported $30 billion in gold exports in the first quarter of 2024, up 40% from the same period in 2023. The destinations were China, India, UAE, and Hong Kong. None of that gold is going to retail buyers. Retail gold jewelry demand has been flat for 5 years. This is institutional accumulation. The clearest signal is vault demand. Gold storage vaults in Singapore, which are privately run and don't require disclosure, have expanded capacity by 2,000 tons since 2022. That's $130 billion worth of storage space added in 2 years. You don't build vault capacity unless you have confirmed demand. Singapore vaults now hold an estimated 4,000 tons of privately owned gold, up from 1,500 tons in 2020. That gold belongs to family offices and sovereign wealth funds, and the fact that they're storing it in Singapore instead of New York or London tells you they don't trust Western financial systems. The acceleration extends to small buyers. Gold coin sales from the U.S. Mint and Royal Canadian Mint hit record levels in 2023. The U.S. Mint sold 1.5 million gold eagles, up from 800,000 in 2021. The Canadian Mint sold 1.2 million gold maple leafs, double the 2021 volume. These are retail buyers, not institutions, but the surge indicates that awareness of the gold move is spreading beyond ultra-wealthy families. Premiums confirm it. A gold eagle normally trades at a 3% to 5% premium over the spot price of gold. In 2023, premiums hit 10% to 12%. That means demand is outstripping supply. Dealers can't keep inventory. Buyers are willing to pay extra just to secure coins. When premiums stay elevated for over a year, it signals structural demand, not speculation. The speed of this move matches what happened in 1979 and 1980, right before gold spiked to $850. In 1978, gold was $200. Central banks and families started buying aggressively in early 1979. By December 1979, gold hit $500. 3 months later, in January 1980, it peaked at $850. The acceleration phase lasted 18 months from initial buying to peak price. We're currently 24 months into the current buying wave. If the pattern holds, the acceleration phase is near. Gold has one function. It holds value when other stores of value fail. It's not an investment. It doesn't generate cash flow or pay dividends. It's insurance against systemic failure. And the families buying $800 billion worth aren't speculating. They're insuring. The first risk is currency devaluation. When a government prints money faster than the economy grows, the currency loses purchasing power. This is inflation at the macro level. The U.S. money supply, measured by M2, increased from $15 trillion in 2019 to $21 trillion by 2024. That's a 40% increase in 5 years. GDP grew 15% in the same period. The extra 25% is inflation waiting to show up in prices. Gold protects against this because its supply grows at 1.5% per year from mining. That's the rate of new gold added to the total stock of gold above ground. No government can print more gold. No central bank can create it. The supply is fixed by geology and physics. When currency supply grows faster than gold supply, gold becomes more valuable in currency terms. That's why gold went from $35 to $850 between 1971 and 1980. The money supply exploded. Gold supply stayed constant. The second risk is sovereign debt default. When a government owes more than it can repay, it defaults either explicitly or through inflation. Explicit default means the government refuses to pay bondholders. Inflation default means the government repays in devalued currency. Both destroy the value of bonds and cash. The U.S. pays $1.2 trillion per year in interest on $36 trillion in debt. If interest rates rise to 5%, which is below the historical average, interest payments would hit $1.8 trillion. That's 35% of total federal revenue. The government would have to choose between paying interest or funding Social Security, Medicare, defense, and everything else. Politically, that's impossible. The only solution is to print money to cover the shortfall. That causes inflation. And bonds, which are promises to be repaid in dollars, lose value as the dollar loses value. Gold doesn't have a counterparty. It's not a promise to pay. It's an asset you hold. If the U.S. government defaults or inflates, your gold still exists. Its value relative to other goods remains stable because gold supply doesn't change. The families buying gold are protecting against the scenario where bonds and cash become worth less or worthless. The third risk is geopolitical conflict. Wars and trade conflicts disrupt currencies because governments print money to fund military spending. Every major war in modern history has been followed by inflation. World War I caused the German mark to collapse. World War II caused the British pound to collapse. The Vietnam War caused the dollar to leave the gold standard in 1971. Right now, tensions between the U.S. and China are the highest since the Cold War. Russia and NATO are in a proxy war in Ukraine. The Middle East is destabilizing. Taiwan remains a flashpoint. If any of these conflicts escalate into direct military confrontation between major powers, governments will print unlimited money to fund the war effort. Gold protects against that because it's neutral. It's not a claim on any government. It's recognized globally. If the dollar collapses during a conflict, you can take gold to any country and exchange it for local currency or goods. The fourth risk is financial system failure. Banks are leveraged institutions. They hold a fraction of deposits as reserves and lend the rest. When loans go bad, banks become insolvent. In 2008, the entire banking system nearly collapsed because mortgage-backed securities lost value. Governments bailed out the banks by printing money and guaranteeing deposits. That worked because the crisis was limited to one asset class. The next crisis will be broader. Commercial real estate is collapsing. Office buildings are worth 40% less than they were in 2019 because remote work has emptied them. Banks hold $2.9 trillion in commercial real estate loans. If those loans default, banks take losses. Regional banks, which hold a disproportionate share of these loans, are at risk. In March 2023, Silicon Valley Bank and Signature Bank collapsed in 48 hours. First Republic followed. That was a warning shot. The commercial real estate losses haven't hit yet. When they do, the banking system will face the same crisis it faced in 2008, but this time the government has $36 trillion in debt and limited capacity to bail anyone out without causing runaway inflation. Gold is outside the banking system. If you own physical gold in a vault, it's not a liability of any bank. It's not on any bank's balance sheet. If banks fail, your gold remains. That's why families are buying physical gold and storing it outside banks. They're preparing for the scenario where the banking system itself becomes unreliable. Every financial crisis has similarities, but the current setup has structural differences that make it more dangerous than 2008, 1971, or 1929. The families moving into gold see these differences. The public mostly doesn't. The first difference is debt scale. In 2008, total U.S. debt, public and private, was $50 trillion. Today, it's $100 trillion. Global debt was $80 trillion in 2008. Today, it's $315 trillion. When debt doubles, the system becomes exponentially more fragile because interest payments consume more of total income. At current levels, debt service takes 15% of U.S. GDP. That's the highest since the 1940s, and that's with interest rates at 5%. If rates rise to 7%, which they did in the 1980s, debt service would consume 20% of GDP. That's unsustainable.